While the crowd fights over overpriced hubs, a silent shift is happening. These 5 cities are about to explode in value, and almost no one is looking yet. Most investors are chasing last year's winners, but the real wealth is made by finding tomorrow's winners before the trend hits the headlines. We don't guess. We track migration data, corporate headquarters relocations, and billion-dollar infrastructure spending. After analyzing thousands of data points across the US, we've identified a specific pattern that repeats right before a market breakout. Today, we're unveiling the 2026 migration map. I'm giving you the 5 most undervalued cities where job growth is skyrocketing, but entry costs remain shockingly low. By the end of this video, you'll have a precise blueprint to diversify your portfolio and secure high-yield assets before the 2026 surge. Let's dive in. Most investors are playing a losing game. They're chasing the same 3 or 4 hot markets everyone talks about on social media. Miami, Austin, Phoenix. But here's the cold reality. By the time a city becomes a trend, the real money has already been made. You're not investing in growth anymore. You're investing in a peak. For a serious portfolio, that's a dangerous position to be in. You're seeing entry costs skyrocket while rental yields plummet. You're fighting over scraps in saturated markets, paying massive premiums for properties that barely cash flow. It's a race to the bottom. While you're competing with 1,000 other bidders, a silent migration is happening right under your nose. Capital is moving. Corporate headquarters are shifting. But the crowd is still staring at the same old, outdated maps. If you keep following the herd, you're not diversifying. You're just buying someone else's exit strategy. The biggest gains aren't found in the cities everyone knows. They're found in the cities everyone is ignoring. If you don't pivot your strategy now, you'll be left holding an overpriced asset in a market that has already hit its ceiling. The window to get in early is closing. Stop chasing the bubbles. If you're looking at the same cities everyone else is, you're already too late. You're buying at the peak. To build real wealth by 2026, you need to follow the migration map. This isn't about guessing. It's about following the money, specifically corporate headquarters, semiconductor plants, and tech hubs. We're looking for the sweet spot: high job growth, low entry costs, and a desperate need for quality rental housing. Let's dive into the 5 cities where the smart money is moving right now. First up, Huntsville, Alabama. They call it the Rocket City. Why? Because it's a global hub for aerospace and defense. These are high-salary professionals moving into a market that is still shockingly affordable. The play here: midterm rentals for contracting engineers. High yield, low competition. Next, we move to Columbus, Ohio. The Intel effect is real. Intel is pouring billions into a massive semiconductor cycle. This creates a massive ripple effect. Thousands of secondary jobs follow the primary investment. Look for properties within a 30-minute commute of the new tech corridors. You're buying today's undervalued suburb for tomorrow's tech hub. Third on the list, Indianapolis, Indiana. Indy is the logistics capital of the Midwest. While others chase volatile growth, Indy offers stability. It's the crossroads of America. The entry price is low, the cash flow is consistent, and the vacancy rates are plummeting. Perfect for the investor who wants passive income without the drama. Now let's talk Texas, but not Austin. San Antonio. While Austin became a playground for billionaires, San Antonio remained undervalued. It has a diversified economy: healthcare, military, and tourism. It's the safer, more sustainable bet for long-term appreciation. Finally, we have Raleigh, North Carolina, the Research Triangle. This is where education meets industry. You have 3 world-class universities, fueling a constant stream of high-earning talent. The demand for luxury rentals is skyrocketing, but the inventory can't keep up. The strategy here: value-add flips. Buy a dated home in a growth zip code, modernize it, and capture that high-end renter market. That's the map. 5 cities, 5 different growth drivers. The key isn't just where you buy, but how you diversify. Now, spotting these cities is the easy part. Executing the buy is where most people fail. You don't need to fly across the country to manage a property yourself. That's a job, not passive income. If you want exposure to these high-growth markets without the landlord headache, I recommend the crowdfunding platforms linked below. You can diversify your portfolio into institutional-grade assets with a few clicks. For those already owning rentals, stop leaking money on bad management. Use the property management software in the description to automate your cash flow. And if you're scaling fast, you need a professional tax strategy. Don't let the IRS eat your gains. I've linked my top-rated tax strategy consultants below to help you protect your wealth. Click the links in the description, secure your spot in these markets, and I'll see you in the next video.